I've spent a lot of time talking and writing about the performance and valuation of growth stocks versus value stocks over the last few years, usually jumping right into the weeds, talking about our views and positioning. And while those are important, I've also realized that there is often confusion with some of the terms and what they mean to different investors. For example, while labels like growth and value sound descriptive, they are also pretty generic. So I thought it might be helpful today to discuss what those labels mean. And from my experience, the best way to do this is looking at a few specific examples. As this slide shows, some of the companies that would fall into that growth stock category would be Google, Tesla, Amazon, and Microsoft. All companies that are experiencing rapid growth in their underlying businesses. On the right-hand side are examples of companies that are typically considered value. Bank of America, Exxon, Procter & Gamble, Johnson & Johnson. Companies that may also be growing, but at a slower rate, and more often than not, they are well-established businesses in mature industries. One thing that you don't see in those descriptions is any mention of the stock price or returns. That's because the growth or value label is really a description of the company's underlying business, and that may or may not translate to the performance of the company's stock. A logical follow-up question from that would be, why? Why wouldn't a company that is experiencing faster than average growth in sales or earnings not also expect to see its stock price grow faster than the average stock? It's a great question, and the answer in its simplest form is that a good investment is about more than just growth or a company's prospects for growth. It's about two things, price and prospects. It's why not every fast-growing company is a good investment, and it's also why slow growth or no growth businesses at the right price can be a great investment. This is the point where I often get pushback. The long-term results are hard to argue with. Yes, there are outlier stocks in periods of time, sometimes quite long periods, where growth beats value or value beats growth. But over those longer periods of time, as this chart shows, the returns for growth and value stocks don't end up being all that different. What that tells us is that valuation or price matters. And it's why our entire process is focused on making sure we stay focused on that all-important variable. If it feels a bit like I'm picking on growth stocks today, well, I probably am. And I think this chart will help explain why. In our earlier video, I mentioned that the price to earnings multiple for the US large cap market didn't tell the full story. In its entirety, US large cap stock valuations shown on the left of this graph are about average. But if we peel back the onion a bit and divide that market into growth and value companies, we see a meaningful difference. Large cap growth stocks, shown here in the middle, trade at a premium or higher multiple than they usually do. While large cap value, shown on the right, trade at a discount. As an investment manager that believes the best indicator of future returns is valuations, it's probably no surprise then why we favor value stocks today. I'll also add that while we focused on the US large cap market for this discussion, we see the same dynamic playing out in other markets, and it's why we continue to favor value over growth throughout the equity portion of our client portfolios. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this video. Thank you.